Welcome back to Investing Talk Podcast.
Great to be here.
Today we're looking at a really interesting infrastructure play, a company right in the middle of this whole AI build-out.
That's right. We're focusing on Applied Digital. And they're moving fast, really aggressively pivoting their entire business,
Yeah, focusing on becoming this pure play provider for AI and high-performance computing infrastructure. It's quite a shift.
It really is.
So the big question we want to tackle for you listening is pretty straightforward. Is Applied Digital a good buy right now?
Mm-hmm.
We're going to break down the fundamentals, the numbers, the charts, give you the whole picture.
And while we do that...
Oh, yeah. Definitely hit that subscribe button if you haven't already. Like this discussion, leave a comment.
And let us know.
Yeah, tell us if there's a specific company you want us to analyze next time. Just drop it in the comments.
Okay, so let's get into it. The fundamentals first. Applied Digital, like we said, they've kind of shifted gears.
Right. Moved away from their older business.
Exactly. Now it's almost entirely about HPC high-performance computing and these very specialized AI data centers.
Which kind of positions them as a, what did you call it, a backdoor play.
Yeah, a backdoor into the AI compute explosion. They're providing the essential plumbing, basically.
But what makes them different? Why aren't they just, another big data center REIT? There are plenty of those.
It's about the specialization and the density. So your typical REIT offers sort of general purpose space and power.
Okay.
Applied Digital builds these highly customized, super high density sites. They're specifically engineered for the heat and power demands of the latest GPUs.
AI chips.
AI chips, yeah. Stuff that, frankly, traditional data centers struggle with. They can't cool them efficiently.
Ah, I see. So they're building the special houses for these power-hungry chips.
Precisely, and that lets them grab these specialized higher margin contracts.
So the back door means they're not directly competing with, say, AWS, but they're enabling others, maybe AWS competitors or specific AI projects, to get the compute they need.
You got it. And the demand for this kind of specialized setup, it's pretty staggering.
We saw that in the revenue numbers, didn't we? Fiscal year 25 revenue hit, what, $144 million?
$144.19 million. Yeah, that's up about 5.5% year over year from fiscal 24. So clearly strong demand.
But the investment side of the story, it's just as dramatic, maybe more so. That net loss, it widened significantly, almost negative $234 million for fiscal 25. That's a lot of red ink.
It is, and it's the upfront pain, right? Building these specialized facilities, these billion-dollar campuses, it costs a fortune before the revenue flows in.
So the loss reflects that huge investment needed to build the capacity.
Exactly. It was basically necessary to secure the kind of long-term commitments that guarantee future cash flow. You have to spend money to make money, especially here.
And those commitments. Let's talk about Coreweave, because that seems absolutely central to the Applied Digital story.
Oh, it's critical. You really can't overstate the significance.
How big are we talking?
Applied Digital locked in cumulative contracts with Coreweave worth over $7 billion.
$7 billion.
Yeah. And Coreweave, for those who don't know, they're a major player. One of the fastest growing providers focused purely on GPU cloud access. They need the exact kind of infrastructure Applied Digital is building.
So that $7 billion isn't just a potential deal, it's
validation. It validates Applied Digital's whole high-density model. And, crucially, it guarantees a huge revenue ramp over multiple years. That security changes the whole risk picture, even with those current losses.
Right, the guaranteed revenue. That helps make sense of what you call the earnings paradox. Because looking back, the EPS, the earnings per share for the last 12 months, it's negative $1.16. Looks bad on paper.
Looks bad, yeah.
Yeah.
But here's the twist.
What's that?
Despite that negative number, they've beaten the consensus analyst estimates for EPS every single time over the past year. 100% beat rate.
Wow, really? 100%?
Yep. Compare that to the industry average, which is around 67%. They are consistently outperforming expectations.
So management is maybe guiding cautiously and then delivering better results.
That's what it suggests. Good execution, they're hitting their marks, and then some.
Which obviously builds confidence for the future, right? The earnings aren't just expected to grow, they're expected to accelerate a lot.
Dramatically. Once those new AI data centers are fully online and those huge Coreweave contracts kick in properly, yeah, it's projected to be an inflection point.
And the market seems to be pricing that inflection point in already. The market cap is sitting around, what, almost $6 billion?
$5.97 billion, yeah. Reflects that long-term potential people see, despite the short-term red ink.
Okay, but let's tackle the elephant in the room for a lot of investors. The the balance sheet, it looks stretched.
Mm.
You've got high debt levels and basically zero free cash flow right now. Isn't that super risky? Relying so much on future contracts, especially from one big client, to cover today's building costs.
It's definitely a high risk, high reward, no question. But you have to see the debt as a conscious choice, a strategic trade-off. Meaning they're deliberately borrowing heavily now to capture the specialized AI hosting market share while the iron is hot. While demand is peaking, they're prioritizing speed and scale over a clean balance sheet today.
Leveraging up to build fast.
Exactly, funding that new data center construction. And because they're still deep in that investment phase, yeah, you're not going to see free cash flow surplus yet. It's sort of a necessary evil in this specific race.
Okay, so the market, you're saying, is kind of looking past the current losses in the debt because it sees that guaranteed future revenue from clients like Coreweave.
Largely, yes. And that sharp focus gives them momentum. It really separates them from the general data center crowd.
Right, that pivot towards next-gen compute makes them a front runner in a very specific high-growth area.
It does. They've carved out a distinct niche based on density and handling those powerful GPUs. That's their differentiator.
So if the long-term story holds water, the technicals, the charts, should reflect some of that confidence, despite the debt.
You'd expect to see it, yeah.
And we did see that big surge recently, didn't we? Stock jumped like 30% after the last earnings report, Q4 25.
That was a big validation move, yeah. The price now is hovering around $21.71, which looks pretty impressive when you think the 52-week low was down at $3.31.
Huge move. So technically, a clear uptrend established.
Oh, yeah, definitely an established uptrend.
And the moving averages back that up.
They do. The stock's comfortably above its 50-day moving average, which is around $15.89, and it's way above the 200-day, which is sitting near $9.91.
Okay, so solid confirmation of sustained bullish momentum.
But, and this is a big but for anyone thinking of investing.
Uh-oh, what is it?
You need to be ready for a wild ride. The stock's beta is 6.46.
6.46. Okay, explain that. What does that mean in practical terms for an investor?
It means this stock is incredibly sensitive to overall market movements, highly leveraged. If the general market, like the Nasdaq, moves 1%, Applied Digital could easily swing 6, maybe even 7% in the same direction.
Oh, so expect big swings, up and down.
Absolutely. Volatility is just part of the deal here. You have to have the stomach for it.
Okay, good warning. What about momentum right now? Is it overextended after that run?
Actually, the momentum looks pretty healthy. The RSI, the 14-day Relative Strength Index, is sitting around 51.86. That's quite neutral.
Neutral is good here.
Yeah, it suggests the stock has kind of digested that recent good news and is consolidating. Importantly, it means there's likely room to run higher before it gets into that overbought territory where technical traders might start selling.
And the near-term forecast, what kind of trading range are we looking at?
Based on the technicals, the current thinking points towards a range roughly between 21 and 26 in the near term.
Okay. And the Wall Street analysts, what are they saying?
Overwhelmingly positive. The consensus is a strong buy. You've got 10 out of 11 analysts covering it with that rating.
That's pretty unified.
It is. But look at the price targets. They range pretty widely, from $13 on the low end all the way up to $30.
Quite a spread. What does that tell you?
It tells me there's high confidence it's going higher, definitely. But there's also uncertainty about how fast they'll ramp up and fully utilize all that new capacity they're building. The timing is the question mark reflected in that range.
Okay, that makes sense. Which leads us perfectly into the catalysts. What could move the price soon? Like over the next, say, 3 months?
The absolute number one thing to watch is the next earnings report. Q1 fiscal year 2026.
When's that expected?
Could be October 9th, could be October 24th, 2025. We're watching for the exact date, but that report is critical.
Why so critical?
It needs to show real, tangible progress. Progress on utilizing the capacity, progress on those big contracts turning into actual revenue. If they deliver strong numbers there, you could see a really significant move upwards. High probability catalyst.
And they're still building, right?
Yeah.
Physically expanding.
They just announced in September they're breaking ground on another massive campus in North Dakota, Polaris Forge 2. It's a $3 billion project.
$3 billion more. Wow.
Yeah, it shows they're doubling down. It's tangible proof they're executing on that aggressive growth plan. Shovels in the ground.
We should also probably mention institutional money flows, right? Those can sometimes give a stock a nudge.
Good point. There's potential for flows from ETF index rebalancing. That's set for around November 1st, 2025.
Okay.
And then later, around December 10th, we'll get the 13F filings. That gives us a clearer picture of which big institutions are buying or selling. Those flows can definitely add momentum.
And inevitably, with a hot stock in the AI space, there are rumors swirling around too, right? Any speculative buzz.
Always. The chatter includes unconfirmed talk of landing another huge AI client, maybe a mega client partnership. That would be big for diversification away from Coreweave.
Hey.
And there's also always some background noise about potential acquisition interest. Could a big tech company want to snap them up to secure that specialized capacity? This is all just rumor, though.
Understood. Exciting, but stick to the facts. Let's circle back to the risk, though. You mentioned volatility. What's the biggest fundamental risk here?
Execution risk. Plain and simple. That's the big one.
Mm.
Meaning, given the complexity, the cost, and the fact they're still losing money on paper, management absolutely has to execute flawlessly. Building these massive, complex facilities on time, on budget, any significant slip-up, any delay or cost overrun could hit the stock price really hard.
Okay. Makes sense. And the other risk we touched on?
Concentration risk.
Yeah.
Relying so heavily on Coreweave, those deals are fantastic, they guarantee growth, but having so much revenue tied to one customer is always a risk long-term. Diversification will be key down the road.
It's just to hammer it home.
And yeah, market risk, that high beta, 6.46. Every piece of news, good or bad, gets amplified. You have to be prepared for that.
Okay, so let's wrap this all up. Pulling everything together, the AI tailwind, the big contracts, the growth, but also the debt, the losses, the risk. Where do we land? What's the overall take?
Look, considering the huge structural demand for AI data centers, the guaranteed growth coming from those locked-in contracts, and the strong technical picture right now, our overall rating comes out pretty strong, an 8.5 out of 10.
8.5, so quite bullish.
Very bullish, yeah. We think the strategic positioning and the security from those contracts outweigh the very real near-term risks around debt and the current losses.
So who is this stock suitable for then? What kind of investor time frame?
It actually offers kind of a dual opportunity, you see.
How so?
Well, with those near-term catalysts like earnings coming up, it looks suitable for shorter-term trading if you're inclined that way, catching potential pops on news.
Okay.
But fundamentally, because of that multi-year AI and HPC growth story, it also looks like a strong candidate for long-term investment. If you believe in the theme, you can potentially ride it out for years.
Short-term trade potential, long-term investment case.
Got it.
Okay, here's a final thought we want to leave you, the listener, with. Something to chew on. Given the high debt, given those massive contracts, what's the one specific metric you should really zero in on in the next earnings report? The number that truly tells you if management's big bet, this aggressive expansion, is actually working.
That's a great question. And the answer is likely the capacity utilization rate.
Utilization rate.
Yeah. What percentage of their newly built infrastructure is actually being used, generating revenue under those contracts? That number, showing how fast they're filling up the space they build, will be the clearest signal for when they might hit that crucial profitability inflection point.
That's the number that validates the whole strategy.
Exactly. That's the one to watch closely.
All right. Excellent insights. Thank you for breaking down Applied Digital for us.
My pleasure. Always interesting stuff happening in this space.
And thank you for tuning in. We'll catch you on the next one.